A lot of people getting excited about a new prediction for gold price heading above $10,000 an ounce. $10,000 an ounce. That guy has to be crazy, right? Right? $12,595 an ounce. That is the new target making the rounds for gold. And if you've been anywhere near financial Twitter this week, you've seen it. This comes from Dan Oliver, founder of Mermican Capital, and it's based on one thing. It's based on gold as a rising percentage of central bank reserves. Now, if that shift plays out, it would take gold from, $5,000 an ounce today to a number more than 2.5 times that. So is this hype? Well, maybe. A lot of that pylon commentary definitely is, but before we write that whole thing off, we should at least consider where it comes from. Because regardless of the specific number that one person is calling for, the mechanics behind this whole idea aren't crazy. Now, we're going to get into all of that, but first a quick shout out to channel sponsor Summit Metals. If you're looking for gold and silver, they have you covered. If you're looking to sell gold and silver, they can help you there too. SummitMetals.com. So where does $12,595 come from? Well, the core argument is simple. Historically, central banks held between a third and a half of their reserves in gold. Now today, that number is way lower. Most reserves are held in sovereign bonds and foreign currency and financial assets. So the idea is that if markets force central banks back toward that 33 to 50% of their reserves in gold, the implied price would be somewhere between $8,395 and $12,595. And that's without the wild case of closer to 100% of reserves in gold that you'll hear people give now and then as really a true hype event. So he's just using the current setup, the historical ratio, and a little bit of math to get that new number. So in short, if gold needs to become a much larger share of the global reserve system, then the price has to adjust. And that's the variable. So what would make central banks move from 10 to 15% in gold to 33 to 50%? Now, he's not talking about a hype event here. He's talking about a shift that's already happening. Foreign investors scaling back their reliance on US dollar assets. Now, he's saying there's a point the Federal Reserve would have to stabilize the market through large-scale bond buying. So this is not a question of whether gold can mathematically reach $12,595. It's what would have to fail to force the Fed into that spiral. And the spiral we're talking about here is a case where higher interest rates lead to higher deficits, which lead to a greater supply of treasuries, which pushes interest rates even higher. And if the market can't absorb that kind of supply at those rates, well, the Fed becomes the only buyer. So no confidence in U.S. treasuries, and really gold is no longer just an alternative. It becomes the safe asset. Now, just to level set here, at $5,000 an ounce, gold is up more than 70% in 12 months. And even after a sharp correction, it's only down around 9% from its all-time high. And that more or less confirms that the move that we've seen isn't some kind of speculative frenzy, it's actually structural. So a number like $12,595 might seem extreme, but in this context, it isn't coming out of nowhere. So where does silver fall into all of this? Well, it doesn't. Silver is not held by central banks the way gold is, and its recent run to $120 was not purely structural. We just saw it give up 35% from its all-time high, and that says something too. There was speculation in play, and there probably still is, meaning I think it has real potential to climb back up, but not for the reasons that we're seeing given for gold. So a forecast of gold climbing up somewhere between $8,395 and $12,595. Why are we even giving this any attention? Well, again, it comes back to the life cycle or trying to guess at the stage that we're currently in. Is $5,000 a peak or is it a valley? Well, this past Thursday, we saw both metals fall further. Gold fell 4%, silver fell another 10%, and based on stronger than expected jobs data, the market just thought there was a reduced rate cut expectation. Now, to add to this, when gold broke below $5,000, it likely triggered some stop losses that would have added to the selling. And if you're trying to figure out if this $5,000 and below number was a dip, well, this past week really didn't give a whole lot of signals beyond the market reacting to basic macro data. So if Thursday's drop wasn't a signal that we hit some kind of peak, what would be? Well, A real signal would be a sustained drop, where stop losses get triggered, it forces automatic selling that pushes prices even lower, and then triggering more stops. That would mean gold would fall well below 4%, and there would be no immediate buyers snapping up that dip. But that isn't what happened. We actually saw buyers step right back in, taking price back above where we were before that jobs data hit. Now, this kind of movement is important. We saw a modest drop followed by a quick recovery. So the strong jobs data pushed gold lower, softer CPI pulled it back up. So these are small moves that are easy to follow. Headline CPI came in at 0.2%. That was lower than expected, so it made sense that gold would rally. Basic cause, clear effect. So really what this points to is a gold market that still has legs. So when you hear a number like $12,595 an ounce, it's going to seem extreme, and it should, but directionally, that argument isn't crazy. Now, the number itself isn't really the point. $12,595, that's just math on a different ratio. The real question is what happens if gold continues to become a larger share of global reserves? Not necessarily 50% of them or 100%, just more. And if that trend continues, the price doesn't have to go to $12,595 for that direction to be interesting, because even a modest shift in allocation in a system as large as central bank reserves changes the whole dynamic. So forget the number for a minute. Just look at the formula. Central banks don't set the price. They buy in the open market. And the gold market is too small to allow that kind of additional demand without moving price. Their purchases already account for roughly a third of new global gold production. So if a category already taking a third of supply increases its buying, price has to adjust. That's why we're seeing these big price targets. Even a modest increase in reserves could send gold a lot higher. And let's call it good there. Let us know where you think we are in this cycle. Is this a peak or a valley? Are you still buying with gold above $5,000? Let us know. And then while you're in the comments, be sure to hit that like button if you found any of this interesting. Be sure you're subscribed with notifications turned on if you want to hear more on the topic. And if you're still here, thanks again for watching. I always appreciate your time. Take care.